Good morning, ladies and gentlemen, and welcome to the Murphy Oil Corp. First Quarter 2023 Earnings Conference Call. If at any time during this call you need assistance, please press star zero for the operator. I would now like to turn the conference over to Kelly Whitley, Vice President, Investor Relations and Communications. Please go ahead.
Thank you, Joelle. Good morning, everyone, and thank you for joining us on our first quarter earnings call today. Joining me today is Roger Jenkins, President and Chief Executive Officer, along with Tom Morales, Executive Vice President and Chief Financial Officer, and Eric Hampley, Executive Vice President of Operations. Please refer to the informational slides we placed on the Investor Relations section of our website as you follow along with our webcast today. Throughout today's call, production numbers, reserves, and financial amounts are adjusted to exclude non-controlling interest in the Gulf of Mexico. Cautionary statements. Please keep in mind that some of the comments made during this call will be considered forward-looking statements as defined in the Private Securities Litigation Reform Act of 1995. As such, no assurances can be given that these events will occur or that the projections will be attained. A variety of factors exist that may cause actual results to differ. For further discussion of risk factors, see Murphy's 2022 annual report
long time. This is a significant undrilled fault block near a Cascade Chinook field that we purchased from, or formed a JV rather, with Petrobras years ago. It comes with an FPSO that sits in that field, a very highly successful FPSO with incredible cost structure and uptime, a real asset for us. And we've had this well in our books, had to work out some things with our partners, and then now spud that well yesterday, and real excited about that well. We do have a backlog of other opportunities that I'll have Eric address involving development here. Eric, why don't you update Arun on that?
Okay, thanks, Roger. As we highlighted on our last quarterly call, we have been working over the last several years with some of our recently acquired fields and have come up with a number of projects. And as we highlighted in our last quarter, we have quite a nice running room of offshore projects that will perform over the next 5 to 7 years, including 26 projects with 125 million barrels of total resource that have a break even of less than $35 a barrel WTI. So we're pretty excited about our development opportunities as well as the exploration opportunities that Roger highlighted.
But with the ongoing activity, Arun, we will be bringing on a Dalmatian well later this year and drilling and hopefully completing a Marmalard well that probably just really can't flow much right at the end of the year.
Should flow early in the 24.
Great. And Roger, I wanted to see if you could give us an update on your plans and non-op and operated plans in Canada. You highlighted 2 wells at Hibernia. And can you give us an update on what you're hearing from the operator at Terra Nova? I think you expect the project start online by year end.
I would normally let Eric handle this, but it's quite simple. We've reviewed the project. And now we have a larger working interest that's funded primarily through a government deal. This is an incredible project. This project will come online. This project will have incredible high return. Hibernia 2 made almost $3 billion of free cash flow itself. So these are significant, successful, long-term fields for us, and we're well positioned there to make a lot of free cash flow in East Coast Canada.
Great. Thanks a lot.
Thank you.
Your next question comes from Neal Dingmann with Truist. Please go ahead.
Morning, all. Thanks for the time. Roger, my first question also on offshore. I'm just wondering, you've been successful, I guess, last year and even other years just on adding very accretive working interest and other things like that offshore. I'm just wondering, could you talk about kind of what Arun was asking? I'm wondering how you would balance, you've got obviously the positive things going on at Kings Quay. You've got some interesting exploration. I'm just wondering how you would balance maybe seeing some additional working interest or other opportunities within those two.
That's a good question, Arun, and thank you for asking about our successful efforts in the Gulf of Mexico. We really don't have a hot running working interest purchase today, quite frankly, and we're really executing our backlog of offshore wells and our long-standing inventory of onshore wells, along with the framework that not the capital allocation framework, but our long-term plans that I disclosed just a few minutes ago in my commentary. We want to keep that CapEx in that range, continue to have this modest growth, and we'll be picking and choosing between our long-term projects in the Gulf and our very significant success in Eagle Ford as well, and be maintaining these oil rates and just have multiple ways to make the same return, and real proud of our inventory, both off and onshore. We got offshore inventory too, and Eric's done a great job at pulling it together, and we're going to be executing it like on slide 12 this year. There'll be another slide like that next year, and real happy with where we are on having the assets to sustain our plan and be successful, and we have them.
Great point. And then Roger, maybe for you or Tom, just second on free cash flow allocation. I believe your debt targets are on a gross, not net basis. So, really looks on reducing debt instead of just adding cash to the balance sheet. And so I know in the past you've talked about maybe wanting a minimum cash balance of, I don't remember, about $400 million or so for M&A and discoveries. So I'm just wondering, given what's going on with prices and your announced recent discovery, I'm just wondering, and I know you've got this Murphy 2.0, would you all consider foregoing 1 to 2 quarters of debt reduction in favor of a cash build, or how do you sort of see that plan going forward?
No, the way we're thinking about it, Neil, is we're going to really focus on getting to that long-term debt target. So our priority right now is to any adjusted free cash flow. We'll stick to the framework and focus on reducing that debt. As you saw in our financials, we are kind of front-loaded here with our capital, so it's probably more of a activity we'll see in the second half of the year, starting to reduce that debt with any adjusted free cash flow we have.
Very good. Thanks, Tom.
I have a little bit of color to add to that, Neil. I think needs to be pointed out. If you look at our cash flow statement today, yes, our cash went down about the same amount of the contingent payments. So we're talking about paying contingent payments into very successful M&A, which there was a revenue sharing, which we received the other half. Also, all this M&A is completely paid out, including acquisition, have been paid out. Khaleesi Moremont's been paid out. Delta House has been paid out. So we have paid out assets, and if we have a severely front-loaded capital and without contingent payments would have had cash flow neutral, I think that's very positive for us and sets us up in the second half to really execute on this framework that we have.
That's a great point. Thanks, Roger.
Thank you, Neil. Good to hear from you.
Your next question comes from Paul Cheng with Scotiabank. Please go ahead.
Hi.
Morning, Paul.
Guys. How are you doing?
Doing good.
A number of quick questions. Maybe the first one, just administrative, that the April contingency payment, when is going to show up in the cash flow statement? Is it in the financing activities or is it in the cash flow from operation?
I'm sorry, Paul, you mean the contingent payments have already been paid. There's one additional payment, as we disclosed in our release, of $25 million. We've already paid it this month. I'm not.
Yes,
where is it, Tom? It will be an operating cash flow, I would assume.
It'll also be split a little bit between operating.
It'll be split between financing and operating. That's due to the original setup of the M&A deal in our accounting, Paul.
Okay.
But that's over. After that, this stuff is over, Paul, for all that.
No, I understand. We're just saying that because I think that investor will be looking at the CFFO number more closely, typically. So we want to know whether that $25 million is going to be in there or is going to be in the financing activity line. Second one, Roger, that in post 2026, once you get to 220,000 barrels per day kind of range, what's the sustaining CapEx requirement going forward?
I believe it's disclosed in that slide, Paul. Turn to that, Megan, please. In the 26-27 period, I would anticipate it to be in the similar level that we are on the left-hand side of that slide at the 900 level, 950 is my expectation for that, Paul.
Okay. And then a final one for me. On the longer term, how's your marketing strategy for money? I mean, right now that you have majority of them sold under fixed long-term contract, and then the rest is to the different part in the U.S. and no spot exposure. Should we assume that will be essentially the strategy going forward?
I'm going to let Eric give you color on that, Paul, please.
Okay, Paul. We have, as you noted, we through 2022 to 2024 put in place a number of fixed forward sales related to our Tupper Montney project. So we, as you know, we increased the capacity of our plants there by 200 million cubic feet per day, and we've had a multi-year program of adding a slightly higher level of activity to get those plants full which we expect probably by the second half of 2024. In order to support that additional capital allocation to the asset, we put in place some fixed forward sales to make sure that we would generate free cash flow from the asset while growing. If you look beyond 2024, we are very unlikely to put in place fixed forward sales like that, but we are likely to maintain a diversification strategy where we've proven over quite a long time now, a decade or so, that we've been able to get enhanced prices by diverse sales into various U.S. markets like Malin, Chicago, Ventura, and Dawn. That's something that will likely feature in our program going beyond 2025. And then we're also looking opportunistically to participate in any kind of value creation that might be driven by LNG projects coming online in Canada or additional gas that needs to come into the Gulf Coast of the U.S. for LNG. So we'll evaluate all of those and have sort of a diverse strategy that maximizes our free cash flows.
Just curious that will you sign long-term contracts or that is really going to be decided on a month-to-month basis in terms of which market you're going to sell to?
What I would expect there, Paul, is a combination of contracts that are based on locking in a differential with transportation from ACO to those diverse markets and other different kinds of arrangements as we can find the best outcome, best deal.
Okay, thank you.
Your next question comes from Neil Mehta with Goldman Sachs. Please go ahead.
Good morning, Neil.
Yeah, thanks. So, good morning, Roger. Congrats on a good quarter here from an execution standpoint. I know you spent a lot of time talking about 2023, and it's early to talk about 24, but you know,
yeah, real early.
I would imagine real early. I recognize that, but I would imagine there are some moving pieces that you want us as an investment community to get our heads around as it relates to production. So, just how should we? Any early thoughts and guidance you can provide on 24 and at an asset level would be great.
Well, thank you, Neil, for that question. Our long-range plan is not even Memorial Day, Neil. I try to gauge questions on holidays. We just finished Easter here. So I would, as for our page that we have here, we have an averaging CapEx shown in our deck here today around 900. That means that CapEx next year at this time and in that plan was a little bit less than this year. We'd hope to keep that similar to what we have this year. We do have a lot of backlog of offshore. We do have success today at Long Claw that will take the place of some of our backlog, if you will, at the point of when we want to do that. And so I would say it's a similar year to next year with higher production because we'll have all of our new backlog wells online, Dalmatian this year, Marmalard next year. And I'd assume it'll be a year similar to this with higher production, higher oil production, and higher overall production.
And then thanks, Roger, for indulging me there. And then the follow-up has been a lot of talk about offshore cost inflation. We're seeing some early signs, hopefully, of deflationary forces in U.S. land, but offshore, still a lot of upward pressure. So can you talk about how you're mitigating it, and are you seeing any green shoots when it comes to the inflationary pressures?
Yeah, thanks, Neil. We've been preparing our answer, and I'm going to let Eric speak to you about that this morning.
Okay, thanks. Neil, the big driver for our costs for offshore is really rig rate, and we're sort of advantaged this year, and we're really happy with how we're set up for 2024 and into 2025. So for about half of our program offshore in 2023, we have a significantly below market rig rate, which we locked in, so around $300,000 a day. The rest of the program, we have locked in pricing all the way through the end of 23, 24, and the first part of 25 at what is effectively market rate right now, which is around $430,000 a day for a drill ship. So we're pretty happy with that, and that should be the main component of something that could be inflationary for us. We have it locked in through early 25. Really happy with that.
Good stuff, guys. Thank you.
Thank you, Neil. Appreciate it.
Your next question comes from Charles Meade with Johnson Rice. Please go ahead.
Good morning, Roger. To you. Yeah, good morning. I wanted to ask a question about these Carnes refracs. So it's really intriguing to me that you had higher IPs than the initial than I guess the initial completion. But I wonder if you could add a few more coordinates to that. And I'm thinking, what's the decline profile look versus the original decline profile, and how maybe the completion design or intensity versus the original completion, and whether you're planning on doing more of these in 23.
Thank you, Charles. Eric's guy that came up with this plan. I'm going to let him tell you about it.
Okay, thanks, Charles. We've identified 220 wells across our Eagle Ford Shale position, which we think are likely to be good candidates for refracs. And the way we came up with that was we looked at wells that were initially fractured with less than 1,200 pounds per foot of proppant. If you compare that to our current completion design of 2,800 to 3,400 pounds per foot, they look quite a bit understimulated. Over the last 3 years, our refrac activity has been focused in Carnes and associated with new development. So we go into an area where we plan new wells and we refrac old wells, which we think that's helping improve the performance of our new wells. And also, as we highlighted on our call today, we're getting nice production uplift and reserve recovery from those refracs. They're pretty exciting. We're seeing rates go from 15 to 20 barrels a day to up to 1,500 barrels a day initially. That's not an IP30, that's more of a peak. The decline profile is not that dissimilar from initial production from those wells when they first came online, maybe 7 or 8 years ago. So it looks like a good opportunity for us. What we do in those wells is we run a 4-inch casing. We go and perf and frack kind of like a new well, just a little bit skinnier hole. And we've had great success with it. We're really excited. We're currently evaluating what might become a standalone program to address that 220 well inventory of refracs. That's not been our current mode, but that's something that we're looking at. Hope that helps you give a little background on what we're trying to do there.
That's a lot of great detail. Thank you, Eric. And my follow-up question, Roger, is I think it's about the Kings Key, the Kings Key facility. And I went back and looked, and I guess the nameplate on that, as originally designed, was more like 102 MBOE a day. And so you guys are something north of 20% over that with this rate you disclosed today. So are you guys? What should we expect going forward? It would seem to me that you're kind of knocking up against the ceiling of what that facility could do, and perhaps we should expect some kind of reversion back to nameplate capacity over time. But perhaps that's not the case. I wonder if you could elaborate on that.
Thank you, Charles, for asking that question. It's a big home run field for us, one of the greatest in company history for us. It's going to be difficult, very difficult to produce more than that headline we had today. Our equipment's running at the max. So let's keep in mind that when we purchased this project and executed this project through COVID, that there's another field in the Gulf called Delta House. It's a very similar facility that has multiple fields flowing to it that we also operate. And that field also has been able to go over nameplate, and our team was able to learn from that as we operate that and take this over nameplate. We're probably not going to see production levels from that, but we're very happy about where we are. We have to also keep in mind that Samurai is a field that's 50% working interest for us, and when Samurai does well, we do well, and the field's doing well and going to be on plateau here into 2025, and it's going to be some additional probably things that we're finding to do in that area. Samurai gets better and bigger every day, so big home run ball, probably can't make much more production than that, but that's a lot of production out of 8 wells. So we're really, really proud of it, and thanks for noting that.
Thank you for the detail, Roger.
It broke up, Charles. I'm sorry.
No, that was just saying thank you for that detail. That's it for me.
You said more. Thought you wanted more detail, Charles. I'd say, wow.
Another time.
Appreciate you calling.
Another time.
Appreciate you
calling
in.
Ladies and gentlemen, as a reminder, should you have a question, please press star followed by the 1. Your next question comes from Leo Mariani with Roth MKM. Please go ahead.
Good morning, Leo. Thanks for calling in.
Yeah, morning. I was hoping to get a little bit more color around the exploration program here in the Gulf. Just on the Long Claw well, you guys announced it as a discovery, but at the same time, I guess you said you're still evaluating it. It's got 62 feet, I guess, of net pay, which, I know it's not the only metric, but doesn't seem, enormous at this point. Just trying to confirm, is this, in fact, definitely a discovery, just given that it sounds like it's a close subsea tieback, probably won't require a lot of capital. And then just on the Chinook well, wanted to see if we can get a little bit more color in terms of kind of rough drill time on this and, what the risk profile on this thing is. Is this a true exploration well, kind of 1 in 5 type well in terms of the expectation? Just any color on that would be great.
Thanks for that question, Leo. No, absolutely. When we say a well is a discovery, we anticipate on producing that well, and we anticipate increasing our working interest on that well. The issue is the size of it. Not issue is we're working it. I'd say it's a 10 to 20 million barrel discovery. But you're talking about a 50-yard tieback from here to my office to flow this well into one of the most successful platforms in the Gulf with manifolds, pipes in place. So the economics of this, similar to Samurai, which are incredible, this will have a incredible economic. And also, as we operate other fields and operate Kings Key, a new set of well not involved with the original field will lower the operating expenses across the whole platform for us and well. So this is a very positive for us. Is it a massive oil field? No, but we can make a lot of money and do well here and work with our partners. And we were able to be carried in the well a little bit, and we're hoping to be able to do that in other places because of our we're a top executing company, Leo, in the Gulf. On to Oso. It is not Oso, I'm sorry, Chinook 7. It is in a field that's been drilled, many wells there. You can see the number 7, if you will. I would say it's a little better than a 1 in 5 exploration well. It isn't a totally undrilled fault block. A lot of these major Wilcox fields, such as St. Malo and also here Cascade Chinook and many others in the Gulf, have 2 big features to them with a large fault down the middle of the field. This so happens to have not been tested. We looked at this and compared it to other wells that have been drilled on both sides of major faults through these facilities, through these type plays. And we have a big, nice well to drill here. It can make this project last out to 2040. The FPSO there is a very, very highly operated, efficient FPSO. We can move the crude off that FPSO where we need to on the Gulf Coast with tankers. So it comes with positive differentials and many positive things for us. So it's near the field, but in a totally untested fault block. And we're very happy to be drilling that well and have a chance to, again, add more to our backlog. The well could get very large in size, requiring multiple wells if successful, or it could be a simple tieback. So real happy about it, and thank you for asking us about it.
All right, that's helpful. And then just on the free cash flow uses here in the second half, it sounds like you're very focused on paying down debt. I imagine that there's probably going to be some takeouts, of some of these existing bonds, kind of like you've done in the past with some tenders here. But just in kind of light of sort of lower oil prices here, does this make the share buyback kind of, fairly unlikely here in 23 with the focus on debt reduction? Do we need oil prices to kind of go up before maybe you buy back shares? Just kind of talk about the dynamic between those two.
I'm going to let Tom add all the color, but our framework, as we set up, has a portion to buy back or advance returns, which we assume to be buyback with debt reduction. So we can end up with less if oil prices are lower, but there's no plan to not buy back at all and due to all debt due to this pullback with the Fed and all that today, Leo. And I'll let Tom give you some more information on that.
Yeah, and that's basically it, Leo. We'll stick to our framework, and as we get into this next phase here, it's definitely going to be splitting between 75% going to debt reduction and 25% going to share repurchase. So with this pullback in oil prices, maybe the quantums will be a little bit smaller than what we would have planned at $75 WTI, but that still is what we're planning to do following our framework, 75-25, between debt reduction and share repurchase.
Okay, that's helpful. And then just on your production volumes, obviously you've got, second quarter guidance here. Very much appreciate the detail there. But just kind of in the rest of the year, can you kind of help us out a little bit with kind of the high-level sort of cadence here? Do we see Gulf of Mexico volumes in 3Q maybe kind of flat to down with just hurricanes, likely here in terms of the way you guys are thinking about it, and then kind of a nice ramp in 4Q? Then I imagine that onshore you're going to see the nice ramp in 3Q as you get the benefit of kind of more wells coming on. Just kind of any help on production cadence in third quarter and fourth quarter, just kind of the big moving pieces here?
Well, if you look at our guidance today for the second quarter, making a little bit less in the Gulf of Mexico, we have to shut in Kings Key for a few days here coming up to do a turnaround of some equipment we need to update there. And then actually in our lineup, the third quarter, while under a big hurricane downtime, still is higher than the second quarter and a big end of the year. So I'd say it's, right now we've guided, 80 to 81 here in the second quarter, probably trying to get close to 83 in the third, a little higher possibly, and maybe 90, a little more 90 in the fourth quarter there, Leo.
Yeah, Leo, just a bit of background. I think we've noted before that our onshore program is pretty heavily weighted to new wells coming online in the second and third quarter. So you see more growth onshore heading into the third quarter, and then more growth offshore heading into the fourth quarter as we bring online Dalmatian, Terra Nova, the Dalmatian new well, DC90 well, and Terra Nova restart, along with less weather downtime assumed in the third quarter. So third, fourth quarters aren't that dissimilar from a total production rate, with a little more growth from second quarter onshore in the third quarter and a little more growth offshore in the fourth quarter.
Okay, it's very helpful, guys. Thank you.
Appreciate it. Take care.
Your next question comes from Paul Cheng with Scotiabank. Please go ahead.
Hey, guys.
You're back, Paul.
Just want to clarify. Eric, when you're talking about the refrac, those opportunities, 220 wells, that's not included in your current 1,100 well in the Eagle Ford, right?
That's correct. Those are wells that are already producing. They're not included in our 1,100 wells of remaining Eagle Ford inventory. To be addition to that.
All right, thank you. And that, Roger, just curious that in long haul, you only have 10% interest and you're the operator, which is quite unusual for someone with a small percentage like that to be the operator. Is there any game plan in there that will be able to have some arrangement for you to boost the interest, or that, this interest is, I'm just curious that why you would take the operatorship there?
Thank you, Paul. You can operate things at 10%, Paul, when you're real good, and we're real good. So that's kind of how that goes. This was a long-term prospect that was known when we purchased the field, Khaleesi Mormont, and we had our significant discovery at Samurai next door. Several of the partners that in the field owned this opportunity. They came to us to participate in the well, and if you notice in my commentary, in my script commentary, we had an ability to increase our working interest post the well being cased, which we're going to do. So we have an ability to go up to 14.5%. This well is this team that built this prospect really respects our company as an operator. We also have this work going on up in the middle of our most valuable field that we've ever owned, probably. And so we want to operate and ensure operations out in the middle of Kings Key and Samurai. This is located very near. It's also very near. We decided to put the well near one of the production manifolds. So our equipment and a lot of our company's value is there. So we wanted to operate even at a smaller working interest. And we see it as an ability to control the field, operate the field efficiently, safely, and increase our working interest due to our operating skill, and then lower the operating expenses of the facility. So it's a win across the board for us, and the partners are a great relationship with these partners, and they see us as a good operator, and we executed the well farm at a low working interest, and everybody wins today, Paul.
All right. Thank you.
Thank you.
There are no further questions from our phone lines. I would now like to turn the call back over to Roger Jenkins for any closing remarks.
Appreciate everyone dialing in today. Appreciate the questions from our key analysts today. It was good commentary back and forth, and really appreciate that support. And we're here executing another quarter, and we're doing very well. I'm very proud of how we're running our business today, and we'll be talking to you all soon. Take care.
Ladies and gentlemen, this concludes your conference call for today. We thank you for participating and ask that you disconnect your line.